Lithium batteries are a $150 billion market, growing more than 20% a year. And if you're a US investor trying to get direct exposure to it, you're almost out of luck. The biggest player in the world isn't listed in New York. It's not listed in Hong Kong either. It trades on the Shenzhen Star Market, in China. And it makes more batteries than the entire Western world combined. That's the paradox we're going to unpack today. In this episode, we'll answer 3 questions. How did one company in Fujian, China, capture 37% of the global battery market in less than a decade? Why does a $150 billion industry have profit margins under 5%, and where in the value chain does the money actually go? And how can US investors realistically get exposure to the lithium battery theme when the biggest names aren't on Wall Street? These aren't simple questions. Let's get into it. Here's where we are in 2024. The global lithium battery market is worth over $150 billion. Demand hit 1 terawatt-hour, that's 1,000 gigawatt-hours, shipped in a single year. 5 years ago, that number was under 300. The growth is being driven by 2 forces working simultaneously. Electric vehicles account for roughly 70% of demand. Battery costs now make up 35 to 40% of what you pay for an EV, the single biggest cost component in the car. The other 20% is grid energy storage. This is the fastest growing segment. Utilities buying batteries by the gigawatt-hour to store solar and wind power. And the remaining 10% is consumer electronics, phones, laptops, power tools, the original use case, still growing, but no longer the main story. Now here's the uncomfortable number on that slide. Global cell manufacturing capacity has hit 3 terawatts. 3 times actual demand. The industry is in a brutal oversupply cycle. And that oversupply is what's driving the margin compression we'll talk about shortly. Let me put CATL's scale in perspective. In 2024, CATL shipped 475 gigawatt-hours of batteries. Their market share, 37.9%. Their nearest competitor, BYD, is at 17. The gap between first and second place is larger than the entire market share of all Korean manufacturers combined. Revenue was $50.4 billion. Net profit margin expanded to 14% despite a brutal price war. Despite revenue actually falling nearly 10% year over year, because raw material prices dropped and got passed through. The company shipped more, made more profit, and did it on lower revenue. That's what pricing power and vertical integration look like at scale. How did they get here? 2011. A former ATL engineer in Fujian. First customer, BMW. 2018, they surpassed Panasonic to become the world's number 1. 2021, CTP, cell-to-pack technology, eliminating the module layer entirely. 20% more energy density, 15% lower cost. That single innovation widened the gap over Korean competitors by 2 to 3 years. The reason CATL stays profitable while others don't comes down to 3 things: vertical integration into cathode precursor and electrode materials, proprietary pack design that costs 20% less than module-based rivals, and scale. At 475 gigawatt-hours, their fixed costs per kilowatt-hour are dramatically lower. You can't buy that advantage. You earn it through a decade of production. Look at this table carefully. It tells the whole story in one view. Chinese manufacturers, CATL and BYD combined, hold over 55% of global share. Add in the smaller Chinese players, and China controls 69% of the global battery market. That number was under 50% just 3 years ago. The Korean trio LG Energy Solution, SK On, Samsung SDI saw their combined share fall from 24% to 14% in a single year. LG Energy Solutions operating margin? 2.2%. Samsung SDI? Also 2.2%. SK On, which supplies Ford and Hyundai, is still operating at a loss. Now look at the US access column. CATL, no ADR. LG Energy, no ADR. SK On, private. The 3 companies that control the industry's most critical supply chain are essentially invisible to US public markets. Panasonic, at 3.9% share, has a NYS ADR. Tesla makes its own cells and is obviously US listed. And BYD has an OTC ADR, but thin liquidity and geopolitical risk come with it. We'll dig into the investment implications in a moment. Here's the part that most battery coverage gets wrong: technology choice isn't just an R&D question. It's a survival question. There are three dominant chemistries on this slide: LFP, lithium iron phosphate; NMC, nickel manganese cobalt; and Tesla's 4680 format. Each one has a different winner. LFP is China's weapon. Safe, no thermal runaway. 8,000 plus charge cycles. And at roughly $55 per kilowatt hour, it's structurally cheaper than NMC. The downside, 20% lower energy density, which means shorter range per charge in cold weather. But for grid storage and standard range EVs, LFP's cost advantage is decisive. Its share of global production has gone from 30% in 2022 to over 50% today. That shift is structural, not cyclical. NMC is the Korean and Japanese specialty. Higher energy density, better range, ideal for premium EVs. But it uses cobalt, which creates supply chain dependency and cost exposure. And at $80 to $100 per kilowatt hour, it's losing ground on price. As LFP improved, the premium you paid for NMC got harder to justify. The Korean players were slow to pivot, and they're paying for it now. The 4680 is Tesla's wildcard. A new cell form factor, 5 times the energy capacity of the previous 2170 cell. Structural battery pack integration saves 16% in weight. The dry electrode manufacturing process, if fully ramped, should cut costs significantly further. By end of 2024, Tesla's internal 4680 production had reached the lowest cost per kilowatt hour in their entire supply chain. A new LFP factory is also starting at Gigafactory Nevada. Tesla is the only Western company seriously competing at the cell level. $150 billion market. Korean manufacturers barely break even. How is that possible? Look at this value chain. Lithium mining is where we started in episode 7, volatile, commodity-driven. Cathode materials, margins of 15 to 25%. Separators and electrolyte, 20 to 35%. These are the components that go inside the cell. The companies making them, mostly in China and listed on A-share markets, earn significantly more per dollar of revenue than the cell manufacturers themselves. Then you get to cell manufacturing. That's the main battlefield: CATL, BYD, LG Energy, all the names we've been talking about. Operating margins, 2 to 14%. A brutal range. CATL sits at the top through scale and vertical integration. Korean players sit at the bottom. Why? 3 reasons. Battery prices fell 80% over the last decade. Raw material cost drops got passed through to customers, but so did competitive pressure. Every price cut that should have improved margins got competed away. Second, Chinese manufacturers built vertical integration at every layer above them in the value chain. They capture margin at the cathode level, the separator level, the electrode coating level, before the cell is even assembled. Korean players buy those components on the open market. And third, with 3 terawatts of capacity chasing 1 terawatt of demand, every factory has to run to cover fixed costs. You can't sit on idle capacity in this business. Northvolt is the clearest example of what happens when you underestimate all 3 of those dynamics at once. Founded in 2016 by 2 ex-Tesla executives in Stockholm. The pitch: European battery sovereignty. High-quality cells, made in Sweden, reducing dependence on Asia. Goldman Sachs invested. JP Morgan invested. Volkswagen took a 21% stake. Microsoft put in money. BMW signed an order. Over 7 years, Northvolt raised over $15 billion. It became Europe's most celebrated cleantech company. In June 2024, BMW cancelled a $2 billion order. Quality issues. Delivery failures. The cash started running out fast, $30 million a week. In November 2024, Northvolt filed for Chapter 11. By March 2025, it was officially bankrupt in Sweden. $5.8 billion in debt. $30 million in cash. Why did this happen? Not bad luck. Structural disadvantage. A factory worker in Fujian earns $8 an hour. In Germany, 45. No automation closes a 4 to 5 times labor cost gap at an early stage production ramp. Europe and the US have no co-located supply chain for cathode materials, separators, or electrolyte. Those components have to be imported, adding 6 to 18 months of lead time. And yield, the percentage of good cells in every production run, requires millions of production hours to optimize. CATL's yield is reportedly near 99%. Northvolt's, at bankruptcy, was said to be well under 50. The U.S. Inflation Reduction Act provides up to $45 per kilowatt-hour in cell manufacturing tax credits. That's meaningful. But Chinese competitors are still $20 to $30 per kilowatt-hour cheaper on materials alone. Subsidies help. They don't solve the problem. So where does that leave a U.S. investor who wants exposure to this theme? You can't buy CATL. You can't buy LG Energy Solution. You can't buy SK On. The companies that control the most important manufacturing industry of the next decade are largely off the table for U.S. public market investors. Here's how I think about the options that do exist. Tier 1 is direct battery exposure through ADRs. BYD trades as BYDDY on the OTC market. It's number 2 globally, 17% share, and its Blade battery is genuinely competitive technology. But BYD's battery business is roughly 30% of a much larger auto, bus, and truck company. Geopolitical risk is real, not imagined. And OTC ADR liquidity is thin. Panasonic trades as PCRFY on NYSE. This is the cleaner battery story for U.S. investors. The energy division represents about 30% of Panasonic's total revenue and it's Tesla's primary 4,680 partner. The risk is concentration. Panasonic's battery business lives or dies with Tesla's production ramp. But if 4,680 scales as projected, Panasonic benefits directly. Tier 2 is indirect exposure through integrated players. Tesla is the most accessible name. The 4680 program is real and accelerating. But Tesla is simultaneously an AI company, an energy company, an auto company, and a robotics company. Battery manufacturing is just one of 6 bets you're making when you buy Tesla. Size accordingly, and be honest with yourself about how much volatility you're willing to absorb. Albemarle, which we covered in episode 7, is the upstream play. You're betting on a lithium price recovery cycle, not battery manufacturing itself. Here's my honest side-by-side view. BYDDY, interesting, but illiquid. Watch ADR volume before sizing any position. If trading volume is consistently thin, execution risk eats into any return. PCRFY, in my view, this is the cleanest US accessible battery play available today. Undervalued relative to the 4680 ramp potential if you believe Tesla volumes recover. Tesla concentration is the real risk, model it. Tesla, battery is one bet among many. If that's the story you want, size it as a small part of a broader Tesla position, not as a battery-specific allocation. ALB, better for investors who want to trade the commodity cycle. The lithium price bottomed in early 2025. A recovery would lift Albemarle meaningfully. It's not a structural battery manufacturing play. ENVX, Enovix has real silicon anode technology and real customers. Pre-profit, small cap, high dilution risk. Only for investors who can absorb binary outcomes. SSDI, Samsung SDI's OTC ADR rounds out the table. Solid technology, BMW and Rivian contracts, but 2.2% operating margin and thin US liquidity make it a difficult trade. Worth monitoring, not a core position. The honest conclusion, the best pure-play lithium battery stocks are not available on US exchanges. What you're left with are partial exposures, some better than others, none ideal. Understanding that constraint is half the investment thesis. My read on the next 1 to 2 years. In my view, there's a 60 to 70% probability that the current oversupply cycle consolidates around 3 survivors, CATL at the top through sheer scale, BYD through vertical integration, and one Western player supported by IRA subsidies, most likely a US-Korean joint venture. Korean standalone players face restructuring pressure. LG Energy has already been cutting costs aggressively. SK On may not survive as an independent entity. Watch these 3 signals. LFP cathode spot price, currently around $7 per kilogram as of April 2026. If it stabilizes above $8 for 2 consecutive quarters, oversupply is clearing. Albemarle and SQM earnings are the early indicator. Tesla 4680 production rate, Tesla discloses cell production in gigawatt-hours each quarter. Watch for 30 gigawatt-hours annualized from Giga Texas. That's the threshold where 4680 economics become structurally competitive with CATL pricing, not just cost competitive for Tesla internally, but for external customers. And the one to watch on market access, CATL has been exploring a Hong Kong secondary listing. If that happens, it opens direct investability for global investors for the first time and will likely trigger a significant re-rating of the multiple. Track HKX disclosure filings. The lithium battery industry is the most important manufacturing industry of the next 20 years. The supply chain is built. The scale is established. And the Western world is starting the decade behind. For US investors, the game is finding the best available exposure, not the ideal exposure. PCRFY and Tesla for direct access. ALB if you're playing the materials cycle. And CATL on HKX if and when that door opens. I'm Big Z, follow me, see you in the next deep dive.